geopolitical risk it's a theme that's been with markets now for quite some time. So it's nothing new. And for markets, I think there are really two sort of a framework, parts of the framework to keep in mind. I think one is markets are very focused on how the retaliation is relative to expectations, and there were fears that the retaliation or counter sanctions could be much worse. And second is related to that. Let's not forget that markets ultimately have a much narrower focus. Actions at a political level are obviously at one sort of level of impact. But for example, in the past, markets have reacted much more to trade-specific issues than actions that are more sort of politically focused in nature. So that's why for us, look, I mean, this is clearly a risk. Geopolitics is one of our top two risks that we want to keep an eye on. It still has the potential to create some short-term volatility. But today, clearly, the focus is much more on the revival in economic growth, particularly in China, effort to support liquidity. And we think that, at this point, at least, clearly outweighs some of the worries on the geopolitical side. And that's why we think sort of Chinese equities, whether you look at onshore or sort of some of the offshore, Hong Kong listed, is still a market we like. We actually think some of the efforts on liquidity and what we're seeing on margin transactions, that's actually a risk we track much more closely in the short term.
Okay, fair enough. But you do like a fair number of ideas in the fixed income space, especially high yield credit is something that you fancy. Where is it that you're spotting opportunity there?
Well, actually, across some of the risky parts of the credit space. So I think what's been really interesting about the corporate and EM bond market rally since the start of Q2 is they have rallied like equities quite strongly since sort of markets troughed. But we've seen much more that led by higher quality investment grade credit. And more recently, we've seen that start to rotate in some of the higher yielding markets. So we've actually sort of raised our preference for high yield markets, whether that's in developed markets or even to some extent within Asia, which has always been a little bit less volatile in Asia dollar bond markets. But at the end of the day, look, one is from a rotation perspective. If this risk appetite rally has to run, that sort of rotation is something one would expect. And it matches with post-recessionary recoveries in the past. I mean, let's not forget that actual defaults in the high yield space particularly do always rise, and they always rise in the 6 to 12 months after we emerge from recession. But as long as that rise in defaults are not much larger than what markets were pricing at the peak in spreads, high yield tends to be one of the biggest outperformers. So that's the reason why, look, it's in the context of a diversified allocation. We still think investment grade is important, but we think a gradual rotation to high yield, both in developed markets and in Asia dollar, is starting to look much more interesting today.